So, hi everybody, this is Hustle Hub. I'm Giacomo, and today I'm with Martin Tixier. He runs the Macroeconomics Substack newsletter. You can find him on Substack, on Twitter, and all the links will be in the description. Today, we're going to talk about a lot of different topics from macroeconomics in the US, Europe, Asia, especially Japan, and then we'll get into some specific sectors like luxury goods, and he focuses also very much on EVs, raw materials that are necessary for electric vehicles. So Martin, please introduce yourself, and then we'll get into the content of today.
Sure. Macroeconomics is a macro-focused newsletter. I've been providing the big picture on macro and different credit markets since 2009 on different supports. First, I was on Blogspot. I also publish on a regular basis on the website called Seeking Alpha, which is quite famous for financial information and financial analysis. And I've also launched, again in 2022, my own page based on Substack, where I regularly publishes, either on a weekly or monthly basis, global views on different topics and subjects, which can cover different aspects of the market, such as monetary policies, specific stocks and sectors, as well as global credit markets. And as well, looking at commodities, the overall macro toolbox, which is quite extensive. So I wanted to do a quick review about what's going on in terms of the marketplace. There's a lot of moving parts. We've seen a very, very, very significant rally since the end of October. And we got a hint, which was very interesting, coming out of the crypto space. You saw a very rapid rise in pricing at the end of October with massive volumes, which was for us indicative of a massive injection of liquidity in the global marketplace. And for us, Bitcoin is a liquidity indicator. If you look at what happened in 2022, when the Fed started hiking very aggressively its rates, obviously that pulled the rug below fixed income markets as well as Bitcoin. So you had a collapse in both Bitcoins, tech stocks, as well as US treasuries, everything related, every long duration asset, in fact, were impacted by the Fed aggressive stance in hiking. And end of October, given there were discussions about Bitcoin becoming an ETF, as well as a rapid price increase and volumes, obviously it was indicative that something was changing in the marketplace. And since the end of October, we've seen a massive rally in all asset prices, in credit markets, in equities, in tech, in crypto, you name it. Most of the marketplace has been impacted by this massive move in terms of liquidity injections within the global marketplace. And of course, some markets which are more duration exposed, such as the US market, where they have very large capitalization of technology companies, rallied much more than the rest of the markets. The only difference is that a market which also rise a lot in terms of performance was as well the Japanese market, which finally broke out of his deflation spell for the last couple of years and managed to go below the threshold it reached in 1989. So if I look into the executive summary, I've used the phrase permanent high plateau. Why? Because it's a direct reference to Irving Fisher called in October 1929, where 1 week before the total collapse of the US equity market, he wrote in a newspaper that it was questioning itself that if the market had reached a permanent high plateau. So I wanted to do it as a tongue-in-cheek because it tells you that not always economists are very good either in trading or at forecasting the economic landscape and the financial markets. And you have to make a big difference between equities market and the economy. A lot of people say that the financial markets do not reflect the economy. It really depends on the marketplace. It really depends as well of the country. And what we've seen in the last couple of years, we've seen a very, very high level of index concentration in various marketplaces. And it didn't used to be the case for the S&P 500, but given the size of what is called the Magnificent Seven, you see a very, very high level of concentration, but where about 7 stocks are responsible for most of the performance of the index. If you talk about Microsoft, Apple, Tesla, and the latest addition between NVDA, where do you see this kind of level of concentration? Generally speaking, it's a feature of emerging markets. That's not something we're used to see in developed markets at all, but it is a feature. For example, if I take the Brazilian stock index, where you have probably about 10 shares that explain most of the performance of the Brazilian stock market. And it seems that we have an evolution, and we'll talk about that, given the fiscal trajectory of the United States and the problematic significant rise of the US debt levels, which is now around $34 trillion and rises about $1 trillion every 100 days. It seems to us that developed markets are more and more trading like emerging markets. So you can see that the S&P 500 is starting to adopt similar features that we can see in emerging markets when it comes to concentration levels.
Okay.
So that's why we're talking about permanent high plateau level of concentration, and everything is rallying at the same time.
Okay, I think the example that you made works perfectly. For example, for Germany right now, people are starting to call Germany the sick man of Europe. It's underperforming economically, but the DAX is doing pretty well.
Exactly. You have the similar feature in a lot of developing markets. I mean, if you look at inflation and very rapid rising stock levels, not to be hyperbolic or indication of hyperinflation just raising its ugly head, but it's very difficult to short a market when you have significant inflation. It's nearly impossible. If, for example, I look at the performance of the stock market of Argentina or Zimbabwe or Venezuela, all these very, very prominent emerging markets illustration of what can go wrong when inflation is out of control. But if you look at the Turkish market, it is the case. If you had bought some fixed income bonds on the Turkish market, you've been in Turkish lira, you've been obliterated. Whereas if you have bought some equities and you're a local resident of Turkey, you've been pretty much more protected than having a fixed income exposure by having stocks.
Yeah.
In similar fashion, if you look at the performance of US fixed income, if I take the US aggregate index for the last 3 years, corrected by inflation, you're down 35%, which is massive. Whereas on the equity side of the story, it's much better. The S&P 500 has been compounding around 10% for the last 15 years. So effectively, being in the equity part of the equation has been a much better proposal than being over allocated to fixed income. But we'll touch about it because what's happening in terms of fiscal perspective of the US has serious implication when it comes to the famous 60-40 portfolio, the much vaunted 60-40 portfolio, which has been the dominant feature for the last maybe 20 years in asset allocation in the marketplace. So moving to the to our macro thoughts, we use this phrase from Julius Caesar that fortune, which has a great deal of power in other matters, but especially in times of war, can bring about great changes in a situation through very slight forces. So right now you have, in effect, a lot of countries which are in a war economic footing. And you have to understand that the implications since the start of the special military operation from Russia in Ukraine, it's been inflationary. in many parts of the world. That has been the great changes through very slight forces. It's not hasn't started as a world war, but the spillover of what happened between Russia and Ukraine has had massive implication on a global scale. Allocation-wise, the thing which is very much on our radar is the Bank of Japan, because Bank of Japan, due to inflationary pressure, due as well to a very significant rise in wage negotiations, is thinking about ending its negative interest rate policies, which has been implemented many years ago. And these will have very serious consequences for global allocation, because most of the Japanese debt, people forget, are owned locally, are owned in Japan. So as such, it's not as big of a problem of an emerging market country or some overexposed European countries where they have a lot of foreign investors who have purchased their debt. And Bank of Japan is the one to watch because they own very significant size of asset markets on a global basis. For example, if we only talk about the credit markets, it is estimated from a report I saw quite a few years ago by Swiss bank UBS that they own around 12.5% of the US credit markets. So that's very significant, because if suddenly there's a change in the monetary policy and Japan decides to change its stance and starts repatriating assets on a global scale to its domestic market, then you're going to have a lot of duration, a lot of outflows, and a lot of volatility. As we stated as well, it used to be that equity used to be the most volatile market throughout the prism of the VIX index. But if you take bond volatility index, which is the MOVE index, we've seen the last couple of years, investment grade credit and fixed income has been, they have been suffering a lot from renewed bond volatility. And as such, we've seen since the beginning of the year that the performance has been quite erratic. And it has been much safer to say on the light side of duration exposure. Also, as we mentioned, equities have been rallying strongly, in particular in the tech space since the initiation of the rally in late October 2003. And the crypto space gave us the hint that liquidity was about to hit the market again. Most recently, Bitcoin and gold have been rallying very strongly. The question I'd like to ask, and it's open for discussion, is are they seeing something we're not seeing, meaning a return of inflationary pressure building up? That could be the case when you look at ongoing negotiations in various countries when it comes to salaries, wage increase. You see it in Germany, you see it in Japan, you see it in many different ways. There will come a point that this will put tremendous pressure on corporate margins, and that should trigger some kind of repricing. Right now, the earnings are very decent, particularly in the tech space. But going forward, these salary wage increase could represent some additional headwinds and could possibly mark a little bit of a stop in the ongoing rally, which we've experienced since late October. When it comes to the geopolitical picture, that's just our thoughts. We don't want to get emotional because it's very emotional issues when we talk about the current geostrategic landscape with the ongoing war in the Middle East as well as in Ukraine. When it comes to the situation between Russia and Ukraine, we do expect some kind of Carthaginian peace, which refers to any kind of brutal peace treaty demanding total subjugation of the defeated sides. And this is what we think Russia will push for. And of course, there are some continuing serious risk of escalations with the extensions of the potential objectives of Russia towards southwest of Ukraine, meaning Odessa. So we won't touch more on that, but bear in mind that obviously the objectives are changing as the war is progressing. Throughout 2021, on our Substack page and macro picture, we called for the risk of a stagflationary outcome for our clients for Orm Research, which is an independent Brazilian research outfit. And in our presentation, we mentioned that as such, fixed income had to be avoided. And of course, 2002 proved to be very prescient because fixed income were obliterated as well as long duration asset in the course of 2022. And we recommended, because war is inflationary, to take refuge in the commodity space, getting very long the energy sector in terms of ETF sector allocation wise, which was which delivered very strongly in the course of 2022. As well, the performance of investment grade credits overall relative to the US was very poor in 2020 in comparison to high yield, 2022. 2023 showed as well what we call convexity pressure because of the volatility we've seen coming from the Fed and in the fixed income space because of the durations in the long end of the US yield curve. You have to remember that we've seen astonishing move. If I just talk about what we saw, for example, since late October 2023, where the 10 years were hovering above 5%. We started the year 2024 at 3.85. We went up to 4.30 and we're back to around 4.07. So it's a lot. It's very significant move in the 10-year space. And it can be pretty dramatic performance-wise if you have a long duration exposure. Overall, the performance of credit since October has been pretty good. In terms of spreads, you've seen a very significant compression of credit spreads, and particularly in credit default swap space, meaning that credit risk is pretty much not pricing any significant rise of default for the time being. It is not in the market, so we're not seeing a spillover in equities. Generally speaking, credit markets tend to react before equity market when there's a sense of a strong risk of deflationary period leading to economic distress. Normally speaking, you should see in the high yield space a lot of pressure in the credit default swap space in the indices, but we're not seeing it at the moment. And when we talk about the credit canary, the one you want to watch to see if there's any significant pressure coming from credit markets is the most weakest part of the credit spectrums, which are triple Cs, which is the one to watch relative to double Bs and single Bs. So you have overall to watch what credit spreads are doing, particularly when it comes to credit availability. And right now you see that financial conditions in the US are pretty loose. So there's no clear, I would say, a trigger for repricing coming from the marketplace as such. You always have, you could have exogenous factor coming from geopolitical tensions, but the marketplace, at least in credit markets, it's pretty benign, it's pretty quiet. And as such, we're not seeing rising distress coming from credit markets. So overall, the markets here today have improved thanks to better global liquidity. That's why we've seen growth, the growth sector and the crypto space performing very, very strongly. So it's still risk on, but you can see more and more risk building up for the downside. Always the same question, do you need to sell in May? We'll see about it. When it comes to emerging markets, we always look at exposed markets such as Brazil, which has recently come under pressure with commodities. 2022 proved a very stable and performing environment for Brazil, including the currency. 2024 has been so far less favorable. We were talking about what's going on in the fixed income space. I must say I don't like the fixed income space in inflationary environments like it was in 2022. In 2024, I remain a little bit concerned given the volatility in the long end, with the 10-year being all over the place, moving from 385, 430 back to 47. So that's a place, if you're long duration, that where you're going to feel the pain, at least in an investment grade. Being on the short end of the duration in the bucket of 1 to 3 years, that's a sweet spot. And you should be a little bit more preserved from heightened volatility in the fixed income space. I think this illustrates what has been happening in the last couple of years, and we've seen it very much happening in 2022, where you see that the bond volatility index, which is called MOVE versus the VIX index, the bond volatility has remained elevated versus equity volatility. As of late, bond volatility has been receding, which is very supportive of the risk-on environment. But as you can see from the below charts, normally speaking, equity volatility, if you believe in the 60-40 portfolio, should be below bond volatility. This picture is telling you something else is happening. High beta, which is high yield, is in positive territory year to date. Quite interesting that the triple Cs, which are more exposed to the energy sector overall, are now up more than the double Bs market. So they're up by 275% year to date, which is not much relative to equities market. When you think about it, the performance was extremely strong for high yield triple Cs in 2023, close to around 9%. And the overall falling bond volatility has been supportive for the whole risk-on environment, including high yield. If I look at the global CDS credit default swap market, the 5-year bucket, which is the most liquid part of the CDS markets, overall, the indices have tightened. So if I take synthetic CDS between Europe high yield and the US, Europe high yield is tighter than the US because credit quality for European high yield is slightly better than the US. As well, as I said before, financial conditions in the US have been loosening, so it's overall supportive of the current risk-on environment. That's what the chart is showing you from the direction of credit spreads. As you can see, since November, we've seen significant retracement. If I take US high yields, for example, we moved from a significant position of around 400 basis points to close to 300. So that's 100 basis points retracement on 5-year, which is very significant move. So credit risk has trended lower, not higher. If I take the synthetic exposure to credit markets, such as US investment grade versus high yield, the both ETFs to express a view on credit markets in a liquid way are the ETF LQD for investment grade and HYG, HYG for US high yield. And you can see that investment grade has slightly outperformed high yield in the last 6 months. It makes sense because the duration is slightly lower compared to what we looked before, and the credit quality is slightly better. But if you look at the overall difference between both US investment grade and US high yield, the performance-wise for the last 6 months, it's very close. You have around plus 420% for investment grade US versus 3.70% for US high yield. So overall credit markets are fairly stable. What is the US yield curve telling us? Well, you still see a very deeply inversion of the yield curve. Normally doesn't bode well for the US economy. That's what economists are telling you. But given that the Fed is currently on hold and is, as expected, data dependent, market should expect less rate cuts in 2024 than anticipated. And we're yet to see meaningful recessionary indicators coming out of the market. At least the market is not pricing yet a deep recession in the US. We're seeing significant additional of pressure coming from rising credit debts for households. you are as well seeing very big pressure for commercial real estate, and it's this particular sector is deeply exposed through regional banks. What we're seeing is that we're going to see much more concentration in the regional bank space in similar fashion to a crisis which happened in the 1980s. It was the saving and loan crisis, which saw a very significant consolidation of the US financial banking system. And we think we're seeing a repeat of what we saw in the 1990s, which was as well linked to overexposure to real estate, commercial real estate in particular. And as such, you have a very big exposure of regional banks relative to strong US banks, such as the likes of JP Morgan, Bank of America. The regional banks have been overexposed to the sector overall. Something which was quite funny as a tongue-in-cheek, because everyone has been talking about China and the Lehman moments because of their real estate exposure and the problematic situation with a slower than usual economic situation in China, because real estate obviously represents a headwind to the expansion of the Chinese economy. But we find a below relationship of interest. It shows you the correlation between the 5-year sovereign CDS of China relative to JP Morgan, the senior CDS 5-year for a 1-year period. As you can see, the financial risk perception has fallen for US large banks. It's not the case for the regional banks because they are less exposed to commercial real estate in the large banks than regional banks. And as I said, Chinese real estate woes continues to be the headwind for the Chinese economy. So that's why you have a spread difference between JP Morgan and China. And if I take the long view as the chart below, which is the 3-year period, as you can see, it's pretty interesting to see that the CDS of JP Morgan has been pretty tight to the CDS of China. So the relationship has been quite interesting from a credit risk perspective.
Yeah.
Since the beginning of 2022, government bond yields have been rising very significantly on top of inflationary pressures. And the cost of financing for most European countries has recently been very volatile. The European Central Bank is indicating future rate cuts. So that has led to falling European yield and in effect as well, a strengthening of the euro currency in the process. But you have to bear in mind that everyone is going to issue a lot, and I mean a lot of bonds to finance their economy in 2024. So you see massive issuance for France, for the likes of United States as well. So everyone is competing on fixed income markets to issue a lot of debt. It's going to be a record year for debt issuance, and you're going to see competition between sovereign issuance and corporate issuance. And since the beginning of the year, we've seen record issuance in both sovereign and corporate credit markets, both in investment grade and high yield. So it's a very, very strong start of the year for bond issuance. Of course, at higher prices, higher level, given the current interest rate levels. What we've seen year to date is Japan is leading the world equity market. It's already up 19.2% year to date. You've seen a better tone on the S&P 500, which is up 7.4%, mostly thanks to the Magnificent Seven in general and NVDA in particular. German DAX, as you mentioned, the German economy is performing very poorly relative to the equity index of the DAX. Well, the German DAX is helped by China. It's up 6.3% year to date. In similar fashion, the French CAC 40 index, which is up 6.4%, is mostly helped by the very good performance of luxury stocks, which make a big chunk of the CAC 40 index. If you take into account the stocks such as LVMH, Kering, Hermès, L'Oréal, and all these guys. First, you saw a big move on the hope for a Chinese reopening support, which faded a little bit in the course of 2023. But China has helped tremendously European stocks with international exposures such as the luxury sector. Asian stocks markets have been more muted. Performance-wise, it's been very poor relative to Europe and the US. Fixed income overall in China has been performing in the last 3 years much better than the US market. So the perfect trade, as pointed out by Gatecard Research in the last couple of years, would have been to have a 60-40 portfolio, probably 60% exposed to US stocks and 40% exposed to Chinese bonds, for example. And the performance has been much better. Replacing the US treasuries by the Chinese bonds has been a better overall performance in the last 3 to 4 years. This is the biggest story so far, and this is the most important one, we think. This is the trend of the Japanese yen over the US dollar. We can see that in 2022, the Japanese yen move exactly mirrored the move in the US Treasury notes 10-year yield. With the upcoming end of the zero interest rate policy from the Bank of Japan, the Japanese yen did reverse course. Right now, the Japanese yen has bounced very strongly versus the US dollar. So the Bank of Japan's next move is extremely important for world's market because the Japanese yen is the world carry trade to carry a lot of leverage plays all across the world. So what the Bank of Japan is going to do is going to have significant impact in terms of asset allocation worldwide. So it's extremely important to watch what the Bank of Japan is going to do. Because of the external financing position of Japan relative to the rest of the world, Japan has been financing a lot of financial markets all across the world. Not only in bonds, but as well in stocks, as well in real estate, you name it. So we think it is the most important thing to track in the course of 2024 when it comes to global market. Really watch what Japan is doing. I have kind of joked when Japan implemented the negative interest rate policy, given their fondness for Godzilla. We had many years of negative interest rate global bonds. So for us, we were joking that Bondzilla is made in Japan. It's a negative interest rate monster, and as such, for many years, bonds were not paying anything at all. And the move that is about to be operated by the Bank of Japan will have very significant repercussions all across the world. I wanted to discuss quite briefly what's happening in the EV space. We saw last couple of years the burst of the ESG bubble. To illustrate that, we love contrarian bets, and which can be very convex. Everyone was telling during the course of 2020 that the coal sector was dead, no value anymore. Everyone would move to windmills, to electricity, to solar panels, to all of this. And December 2020, we recommended to the clients of Home Research to look at coal plays such as Peabody Energy, as well as Alliance Resource Limited Partners, which were trading at very low level at around $5. And for us, we thought that the ESG bubble would eventually burst, and you still need to burn about 12 tons of coal to produce a solar panel. And emerging markets such as India, such as China, cannot transition very rapidly to green energy overnight. It's a very long-term play, and I think the markets were trading way ahead of themselves. And we think that if you look at the stance coming from the likes of big banks like Bank of America, JP Morgan, relative to ESG, and more recently, BlackRock, the ESG bubble is something of a fade. It's falling in terms of size, and we think that the EV bubble is going to face a similar problem because of the cost of producing and commodities for producing electric car. To produce an electric car, you need to use 2.5 more raw materials than a normal combustion engine car. And that's a lot. And when you think about the amount of copper, cobalt, lithium you need to source, if you want to reach this kind of objective of having only electric car, it's not really feasible in the current environment because of underinvestment in mining. In the last couple of years, you don't have enough mines when it comes to copper, to silver, to provide the industry with all the raw materials needed to produce extensively electric cars. So as such, you can see that the combustion engine right now continue to have more residual value as scrap metal than electric cars, and EV batteries are still very expensive to replace and to recycle. And it's quite a dangerous job to recycle electric batteries because of their explosive nature. So stock-wise, you can see that the market is already switching from the EV bubble to something more of a compromise, which is hybrid. Hybrid cars have a very big future. Aston Martin recently told you, well, we don't really believe in electric cars only. They're not going to take the electric route like some other luxury players are doing, like Rolls-Royce, for example. So stock-wise, the market is already the market is a discounting machine and is already showing you the trend. So if you want to play the EV bubble bursting, Toyota seems to us the right way of playing it. And if you can see that, just taking the one-year chart, you can see that Toyota versus Tesla versus the Chinese BYD is outperforming big time the giants like Tesla and BYD. So no, the combustion engine is not entirely dead for sure. Electric cars are not going to be totally dominating for the time being. So right now, there's still room for compromise, and the leader in hybrid cars is still Toyota. So that's the way of playing it. And if you think that hybrid is going to make a comeback through Toyota, then you want to look at Palladium. Why? Because Palladium, which is in red in the chart, if the EV bubble is bursting, and if we're making the case for hybrid and it's valid, then Palladium is a key commercial use and is the critical component in catalytic converters for cars. I've put the chart below highlighting silver and Palladium. It's a 5-year chart. Why did I put it? Because both AI and Bitcoin depends on a lot of energy, but they also depend on a lot on silver for the hardware. So if you're bullish AI and bullish Bitcoin, well, you're going to have to become a little bit more bullish on silver. And if you think that hybrid is going to make a comeback relative to EVs, then Palladium is very cheap. Little discussions about gold. Gold is now up 5.6% year to date. I continue to see gold very positively because of obviously because of geopolitics, because of also a lot of central banks adding to their reserves aggressively, because of the current struggles and discussions surrounding the BRICS and the potential switch to a new global monetary system. So that's why gold is still in very high demand, on strong Asian demand, on top of geopolitical risk. As well, you have to take into account, normally speaking, when you have receding real yields, which is the case right now, with falling 10-year US treasuries, then what is called the Gibson paradox is supportive for the gold market. What is Gibson paradox? Gibson paradox tells you that Whenever real yields are very positive, then gold prices fall. When real yields are falling, then gold prices rise. Also something to bear in mind, soft commodities such as cocoa. Cocoa has risen to a level which has not been seen in the last 46 years. It's the highest it has been. So you see there's a lot of moving pieces in commodities. Now, from, I would say, a geopolitical viewing, if someone would like to make an analogy, if someone thinks, okay, we see the rise of populist parties in Europe and in different parts of the world, you see a lot of geopolitical tensions, then what's going on in the commodity space? Then obviously there's some room for a continuous rise in commodities if you think that there's some countries which are currently in war economies, and war economies per se are inflationary. And as such, you need raw material. So all in all, this should be supportive of commodities going forward. So pick your year-to-date winner. This race is still on between NVDA, Bitcoin, or cocoa. We thought this chart would be of interest to your viewers because it really highlights some of the crazy performance we've seen since the beginning of the year, with cocoa prices up 65%, Bitcoin as well up 65%, and the winner so far is NVIDIA up around 76, 75%. When it comes to our economic views, we still have a very stagflationary stance for Europe. We don't like what's going on. Germany is being, in the industrial base of Germany is being destroyed due to the energy dependencies of the European economies, which is not the case of the US. US has proven with the shale miracle that they have energy independence, whereas Europe doesn't. So that's why Europe is in a much, I would say, difficult situation than when it comes to United States. When it comes to the direction of the trajectory of the US, for Qs, you can watch what the US Treasury 10-year yield is going to do. Volatility is the name of the game. And as we said before, the direction of US real yields is critical. Gibson paradox, as we said, lower real yields equals higher gold prices. Very simple. We still think that you should look at buying Japanese yen against the US dollar on the potential Bank of Japan change in monetary policy. That should push strongly the yen back against the US dollar. You need to continue to look at what's happening in the European consumer discretionary space. If effectively Europe falls into recession, which could be the case in some of the European countries, then you want to look at what's happening in the European consumer discretionary space. Second part of 2024, maybe we'll see rising pressure coming from the credit market, and as such, you don't want to have big exposure to US high yield, because if effectively we have a slowdown in the US economy, there could be potential for repricing in the US high yield credit space, because currently we think that the spreads are too tight. So keep some USD in cash or money markets or short duration funds. If you want to play gold exposure and some gold miners, there's a couple of names we like. We've put, you can do your own financial analysis, but we like AGI, EGO, GFI. You can have a look at these names because they've been, they have had very good performance for the last couple of years, even more than 5 years. The energy sector is very volatile, and all cues are on oil prices and cuts in production. When it comes to monetary policy, the Fed can afford to be less aggressive in its rate cuts. The ECB, not so much, because of what we're seeing in terms of slowdown in the European economies. So I'm quite negative on European economies from an economic perspective. And markets, of course, are a different story given international exposure on a lot of names such as L'Oréal, such as Hermès, such as all these companies that provide products on a global scale, like Air Liquide, for example. Permanent high plateau, something we find as well of interest. It's the if Bitcoin is on a crazy trajectory, then MicroStrategy, which is deeply exposed to Bitcoin, they even issued recently, I think, another 700 million worth of convertible bonds to buy even more Bitcoin. We think that MicroStrategy MSTR is a leverage play on Bitcoin. And I view it as its second derivative. As such, in any kind of pullback, or if you decide that you want to short, if you want to short better, you're better off shorting MicroStrategy relative to Bitcoin if you think that at some point liquidity is going to be pulled back by central banks, which is not the case right now. Luxury sector, it was smacked big time in 2022. Asian markets remain the hotspot for French luxury brands. And that's where the demand is going to come from in the next 25, 30 years with the rising of the middle class, not only from China, but we're talking about Indonesia, we're talking about Vietnam, all Eastern Asia. That's why now you can see that US would like to pivot more towards Asia, because that's where all the wealth is going to be created in the next decades, for sure. We've seen very strong and positive earnings for both house, for LVMH and Hermès, but overall, we prefer Hermès over LVMH because they have better operational margins. Hermès operational margins around 35%, very high. And we continue to think that Hermès will continue to beat LVMH for a very simple reason, is the power of the brand. I was telling Giacomo before we started the conversation that if you take the secondary market for Hermès Birkin bag, the compounded average growth rate in the last 15 years has been 14% a year, which is absolutely massive. Meaning that if you buy a second-hand Birkin bag, it will appreciate over time because of the dominating brand factor relative to LVMH. Someone can make as well the same case for Rolex watches. Rolex watches are the most actively traded second-hand watches in the secondary market. So we see Hermès like a dominant name, very much in a kind of Warren Buffett approach. They have pricing power and they dominate the sector, which is fantastic. It's a similar, I would say, profile as MasterCard or Visa. They are totally dominating their marketplace.
Okay. Maybe I have a question regarding LVMH and Hermès. Don't you think that they could produce more? For example, I think that Rolex is increasing production. Don't you think that, for example, Hermès could do the same and maybe increase the production, and therefore the value of, for example, the Birkin bag that you talked about could rise a little bit less compared to what it used to be?
No, I don't think so, because that's the smart strategy of Hermès, is to totally control their environment, and as such, they want to control the scarcity of their products.
Yeah.
And if you see recent price increases, Hermès as well as Chanel, all these brands have increased the price for their entry-level handbags. So that's why Hermès is such in high demand. It's very difficult to buy a Birkin bag. For example, you have to be on a waiting list. You cannot buy more than a specific amount. This is really part of their core strategy.
Yeah,
that's why
they're the same strategy, but I think that they were increasing a little bit I don't know
They
if I'm...
are, but they're very much controlling of the scarcity situation.
Okay, okay.
What I wanted to say that since early 2022, the Fed has raised its policy rates to 5.25%, whereas the ECB has raised its key deposit facility to 4.5%. What caught my attention very recently is that gold price performance has been tracking very closely the performance of the Euro USD for the last 3 months. But look what's happening. Since beginning of March, gold is breaking out. So is gold telling us something we don't understand? So we need to watch what's going on. Couple of food for thoughts. Well, the risk-on environment is sustained by loose financial conditions. Financial conditions continue to ease. It's a graph produced by Bloomberg. It shows you that Fed has been hiking rates, as you can see, but the S&P 500 has reached new record levels. So overall, the market health is pretty decent. We're back to where the Fed started hiking. What's going on? Softer US labor demand would entice the Fed to start cutting rates. All in all, it's dependent on what we're seeing in small companies in the US. You have to remember that small companies in the US are very important when it comes to the macro picture in the US. I will give you a few facts, which is a reminder of the US economy. You have to remind yourself that firms with less than 20 employees in the US makes up to 90% of all companies in the US. Small and medium-sized firms employ half of all workers in the United States. Small and medium-sized firms generate half of all revenues in corporate America. And as well, small firms create around 3 million jobs every year. So if you start seeing a sign of softer US labor demand in small companies, it really tells you that you're going to see a turn in the cycle. We're not there yet, but as you can see in this chart, which is quite important, it's been the lowest read since March 2021. So that's something you need to track in the next upcoming month. As you can see, mining stocks are training the gold price. Some gold miners are not tracking effectively anymore the gold prices. Maybe there's a lag. They've been underperforming, but you have to bear in mind that the cost of extractions are energy dependent. So the more energy dependent a gold mining stock is, the more difficult the performance. But there's a few names which are doing much better, as I highlighted. AGI is doing better, GFI, and as well EGO. Is that the US dollar is under pressure, and I expect the dollar to fall relative to other currencies. We've seen a strengthening of the euro relative to the US dollar, and we've seen some dollar weakness coming. So let's see how it is playing out in the next couple of months. Yeah, Convexity has been biting because of rising government bond yields in 2023. So we recommend you stay short duration, given how volatile the markets have been. I'm not buying yet the inflation receding narrative for the second part of 2024. We think we could see a return of inflation in the second part of the year. The European Central Bank, they need to cut because of the slowdown in economic activity. Luxury-wise, we told you, I think Hermès is a better play if you want to play the luxury sector than LVMH, and Asia will continue to support the sector. Gold is stronger again because of a central bank adding to level not seen since 1967. So we're still very positive on gold for sure. You have to also to take into account something which is very disturbing happening in the marketplace, which is the gamma risk, similar to what we've seen in 1987, which is rising. thanks to what is called OTDE options, which are extremely short-dated options. You want to keep that in your radar because that could create an avalanche because everyone is playing the same game in very big size at the same time. So that could be problematic in triggering in case of a very sudden rise in volatility. That could trigger some very serious repricing, very nasty repricing, potentially. And finally, my last graph, it shows you the US dollar against the DXY. So, well, sorry, the US dollar through the DXY index versus the commodities CRB index. That's a 20-year chart. So as you can see, there's potential for maybe more a commodity breakout. It was very muted from the period of 2015 until, I would say, beginning of 2022. 2022, you had the start of the war between Ukraine and Russia. So you had a very significant outperformance of commodities early on 2022. 2023 was not a very good year for commodities, but it looks like it could come back into play. It really depends if we see accelerating demand coming from Asian expansion, coming from China, coming from Asia, coming from India. I think that commodities could be well supported by emerging market demands from Asian demands. And as such, we think that we could see an additional rise in oil prices in the second part of 2024. And this would be dollar negative as well.
Okay. So, yeah, maybe I wanted to ask you a few questions regarding some of the things you said along the presentation. First of all, okay, so I think you made a strong point on Toyota and hybrid that looks more interesting right now compared to EVs and so on. Given the fact that the European manufacturers have been lagging in technology, EV technology, could this trend bring new life to some of the European groups? Maybe you've talked about Germany underperforming and so on, but maybe, for example, could companies like Groupe Renault, Stellantis benefit from
Yes.
the trend?
Stellantis is very much aware about the situation. They haven't bought the all-in into electric vehicles. The CEO of Stellantis, Tavares, has been very vocal on this, and I think he's very cued on his market. And as such, I think Stellantis has a much more prudent approach than some of the German car manufacturers, who are some of them switching totally towards electric cars, which I don't think is the right approach. That's why I've put forward the case for hybrid.
Okay. And
just to give you an illustrative daily life view, whenever I get a Uber, I call a Uber in Paris, a very, very large, significant number of Uber drivers drive hybrid Toyota cars.
yeah,
Most of them are driving hybrid.
yeah, a lot of taxis over here as well, driving Toyotas.
Yes.
So, yeah.
And another important point, which I didn't highlight in this presentation, but you will find in my some of my posts on my Substack, is that you have to remember that Hertz, the renting car company, last quarter lost a lot of money because they had to revalue their exposure to their electric cars, and they had to pass massive depreciation of the fleet. And they, in fact, got rid of most of their Tesla fleet because the depreciation in electric cars is very rapid. And as such, for guys like Hertz, it doesn't make any economic sense, business-wise, to have such a high fleet of electric cars. So you will see them switching towards hybrid as well. So you have serious implications when you see that such a leading car rental company, Hertz, is telling you that they lost money with their electric cars fleet at the last quarter of 2023. then you need to ask yourself, okay, these guys have issues in terms of depreciation on their balance sheet. What are they going to do? I guess they will also, forget about the EV bubble and mentality, and become a little bit more rational and move towards hybrid. It's not that the transition is not going to happen, but I think people have been over-expecting the transition to be rapid.
Yeah.
It cannot be too rapid because it's too disruptive for a lot of businesses. So that's why you have to go through a period of transition, because you have to source the raw materials, you have to build the electric grid, you have to have the infrastructures in place when it comes to be in a position to charge your car everywhere. And it takes times, investments, and money, and it cannot happen overnight.
Okay. And yeah, I was doubtful as well because, for example, I've heard an interview of some engineers and they were talking about, for example, imagine when you have to refill your car and the guy in front of you takes like 2 minutes to refill his car. Imagine the guy in front of you taking 2 hours to recharge his car, his electric car. That would put a lot of struggles on the infrastructure needed.
Yeah, but I would add a caveat to what you're saying. Currently, you have a lot of engineers, even in China, who have made extremely interesting and rapid progress on solid-state batteries, new kind of batteries using different features like sodium batteries, for example, solid-state batteries, which can be charged at a much faster pace. It doesn't mean there's no innovation. There's a lot of innovations right now, but yes, the market is moving very, very rapidly. And I would like also to make a comparison with the big names in the EV space, in similar fashion to what we saw in very disruptive sectors of the economy, such as mobile phones. You have to remember that you had a dominating force in the mobile phone space a couple of years ago, which was called Nokia. Nokia fell apart. Then it was Motorola. And then it was iPhone.
Yeah, BlackBerry also.
And BlackBerry also disappeared. So it is a highly competitive, disruptive place. And you can't expect the leaders of today to be the leaders of tomorrow. The same applies in the electric vehicle sector as it did apply in the mobile phone business, because it's a highly innovative, competitive environment.
Okay. And talking about lithium and all the raw materials necessary for EV cars, there are a lot of talks about, especially coming from the countries extracting these raw materials to build plants in order to have more added value on their turf in their country. Is there anything that shows us that it's likely to happen, or it's very far away? So
no, it's happening very fast, and I think a basket case for very rapid investments in I would say rare materials, rare sources, is happening within Saudi Arabia, for example. You have the PIF, which been allocated a very large chunk of shares from Aramco, which will generate $15 billion worth of dividends on a quarterly basis. So they are deploying massive amount of income towards the PIF, and the PIF have set up a large number of companies investing not only in the extraction of raw materials and large deposit which has been found within Saudi Arabia, but they are as well investing in their own facilities in the production of electric cars and other types of vehicles. So it's on many people's radar. And you have also to take into account that in California, they also found a very large deposit recently of lithium.
Yeah.
So what I wanted to say that during many years, during the ESG bubble, there've been a lot of underinvestment in oil and gas extraction, in energy extraction, as well as in enriched uranium facilities. And you see that I think politicians are becoming a little bit more responsible when it comes to assessing the need to have sensible, intelligent energy policies. And nuclear energy is part of that. That's why you've seen in the last couple of years such a very, very significant rise in uranium prices and uranium-related ETF for stocks such as Cameco, Kazatomprom, Sprott ETF, uranium URNM. I'm very bullish on uranium sector because you need in your mix of energy, you need to include nuclear as well.
Okay, okay. And also in the presentation, you talked about regional banks in the US and their struggles with commercial real estate. I think I watched a video from the Wall Street Journal a few months ago talking about, for example, an office building being turned into apartments.
Yes.
Is it just remote work that is putting a struggle on commercial real estate, or are there more structural issues in this sector?
Well, I think it's I think you have both. Like obviously the confinement COVID-19 was a trigger. The work from home has really put a lot of pressure when it comes to office real estate. When you look at real estate, it's not the case everywhere. Okay, it's very specific to the office space. This is not the case for the likes of like industrial land, for example, in the commercial real estate space. It's not the case for hospitality. You have a lot of large transactions happening in the high-end hotel space and 5 stars, both in the US and Europe. You have a lot of trophy assets being snapped by large family office, for example. So it's really, really within commercial real estate, within the space of offices, as you mentioned. The work from home has been putting a lot of pressure. And it's more a US issue when it comes to exposure bank-wise than a European bank issue. And it's much more close to regional banking exposure than US large banks. So in terms of comparison, that's why I mentioned you need to reread what happened with during the saving and loans crisis of the 90s, because it's exactly the same kind of playbook.
Okay. So I'm done with the questions. If you have anything else you want to add, feel free to do so. If not, I really want to thank you for taking the time and explaining all these trends that are happening.
Well, thank you very much for taking the time for the interview. Don't hesitate to reach out. You can reach me out through Twitter, through Substack. I'd be more than happy to interact with anyone who has specific questions on what has been discussed. That was a very large overview of what I think are the moving parts right now. There's a lot of interesting things happening in the world right now, but you have as well very long-term trends, which you have to take into account. One being the return of the domination of the eastern part of the world. And as such, I would reference the work of Angus Maddison, which used to be the co-chief economist of the OECD, who wrote the definitive book about the history of long-term trends in macroeconomics, which is called Contours of the World Economy. And he has shown the evolution of global economy since before Christ, with a projection up until 2030. And it's a work of art because it really shows how the world economies has evolved regionally during history. And what Angus Maddison used to say is that 500 years ago, the dominating trading forces of the world used to be India and China. And it looks like the pivot to Asia is for real. And we are finally, after 500 years of Western domination, switching back again towards Eastern domination. And that's the long-term trend.
Okay. So thank you for the suggestion as well. And thank you again for taking the time. This is it for today. I'm Giacomo. This is Also Hub. See you next time.